China panics as its economy is crashing at an alarming rate. I'm your host, Steve Van Metre, and thanks for joining me today. And things in China are far worse than we thought as their economy is nosediving. Let's over to Bloomberg, where we pick today's story up as China shocks with rate cut as data show alarming slowdown. China's economic slowdown deepened in July due to a worsening property slump and continued coronavirus lockdowns, with an unexpected cut in interest rates unlikely to turn things around while those twin drags remain. And I want to start this story out today because I want you to understand that the broad narrative is this is all an issue of the coronavirus. Now, just because China is shutting its economy down in different parts, the rest of the world isn't that much. But I want you to see, as we go through today's story, what is really going on is the economy. The global economy was slowing down before the coronavirus hit. That acted with all the fiscal and monetary stimulus as a huge boost for the global economy, and now that's going away. So maybe the story now going forward isn't just about the coronavirus. As retail sales, industrial output, investment all slowed and missed economist estimates in July, the survey jobless rate for those aged 16 to 24 climbed a whopping 19.9%, a record high and a headache for the Communist Party as it gears up for a major Congress in the coming months that's expected to give President Xi Jinping a president-defined third term in power. And the data suggests a crisis of confidence among Chinese businesses and households, adding another threat to the world economy as global demand for everything from Apple iPhones to luxury goods taken on. At the same time, a worsening property slump is being felt at home and abroad as commodity prices such as iron ore and copper plummet. And here we have again the story of global demand slowing. So is the global demand slowing because of the coronavirus? Not anymore. In fact, it did for a while, and then due to all the fiscal and monetary stimulus, that went away. But now we're back. So the real issue again is the global economy is slowing down before the coronavirus. It got boosted up and now it's starting to come back off that. Are we just coming off that high, which is what many people think, off that stimulus high, or are we headed actually back to the downturn that started back in 2018? China's leadership has ruled out large-scale stimulus and vowed to continue with a stringent COVID-0 policy, requiring authorities to shut down businesses and lock down the population when major outbreaks occur, as is the case now with the resort island of Hainan. That's dimming the growth outlook for the rest of the year, which economists are downgrading further below 4%, which for China is amazingly slow. China's central bank cut both 1-year and 7-day lending rates by 10 basis points, a move economists said would have little impact since COVID controls have made households and businesses reluctant to borrow. New credit in July increased at the slowest pace since at least 2017. So in the midst of you're seeing other central bankers raising policy rates, here you have China cutting. They're not cutting because they need a little bit of stimulus. They're cutting because their economy is nosediving. And so when we look to other economies, when we see central bankers start to cut. Now, I'm not suggesting they're going to start cutting in the next couple months, but at some point, we're going to see a shift from hawk to dove, and they're going to do that because the global economy is slowing, and we're seeing that start in China, which makes sense as the world's largest exporter. That's where we should start to see problems. The rate cut shows the entire economy is in trouble, as we note that incomplete projects have made households nervous about buying homes, reducing the impact of lower mortgage rates. And the economy slowdown, which began in March, something our chief strategist Jeff Snyder has pointed out is not just a Chinese phenomenon, but a global phenomenon, that something in March changed and the whole global economy is slowing down together. As authorities in dozens of cities impose lockdowns to control COVID outbreaks, has spilled over to major economies such as Germany and South Korea as China's demand for manufactured goods slumps. The path of economic recovery in the second half will be bumpy and uncertain, which I think it'll be worse than people think, depending on COVID and other related policy developments in the property market and strength of external growth. Given subdued July growth, our current below census growth forecast faces some downside risk, and I think those downside risks are far bigger than most people realize. But if you're concerned what that means for your portfolio, should China nosedive? Well, you shouldn't be. I'll put a link up here to Portfolio Shield in the corner and the description below. Because I went and took a visit to our chief strategist and his buddy, our buddy Emil Kalinowski on Emil's show. And if you want to take your knowledge to a deeper level, check out our recent video of NYTimes Opinion Economy Collection of Vibes, as Jeff makes a very rare prediction about what's going to happen in the economy. Now let's continue on, because the story of China leaked right into the crude oil market as oil prices tumble as China economy stutters, and oil prices slumped nearly 5% on Monday on data showing China's economic recovery stuttering under COVID-19 restrictions and a slumping property sector. Now most people look at the oil market and say, look, there just isn't enough supply, so that is the bullish case for crude oil. I want you to start thinking about oil as an economic indicator. If it's going up, that means demand for energy around the world is strong and is good. Even if there's a supply shortage, it still means there's a demand for energy, and as demand for energy increases, the global economy increases. So as crude oil prices start to come down, and if they continue to come down, it's telling you the global economy is slowing in a huge way. And we've got some charts that I want to show you here. Is we have the Wilshire 5000 total U.S. stock market in red and West Texas intermediate crude prices in blue, both on a year-over-year rate of change. And you can see that before there wasn't a strong relationship. There was some, and then it would kind of deviate a little bit. But if you move into, of course, the last couple of decades, you see the relationship between crude oil and the stock market is strong. And is what it's telling you is as growth slows, crude oil prices here in blue start to slow. And that's the narrative for stock prices slowing down. For everyone who's bullish on stocks right now, they need to see crude oil rebound, because if it doesn't and it heads lower, it's telling you stock prices are also headed lower. And it also has a strong relationship with interest rates. And here we're keeping crude oil prices the same in blue, now overlaying 10-year treasury yields in red, both on a year-over-year rate of change. And notably, the consensus view is that rates must rise, but historically, they tend to follow crude oil prices on a year-over-year rate of change, suggesting that interest rates, as we've talked about on the show, should head lower. But of course, now when we overlay the 10-year treasury yield minus the 2-year yield, or the yield curve, and we adjust crude oil prices back to just the price in dollars per barrel, what we note is that when the yield curve inverts, when those long rates, this is important, when long rates go below short-term rates, it tells you something is structurally wrong with the economy. And it tells you that future growth and inflation expectations are coming down. We could see it. It's predicting that in the crude oil market. As you see, an inversion here eventually led to a peak in crude oil a short while later, shown in blue. So here we see inversion. Now at the same time, a peak in crude. An inversion led to a big surge in crude on supply issues, which came crashing down. We see crude oil started to peak ahead of what wasn't quite an inversion, and now we're seeing an inversion in crude oil prices peaking. Now, the risk of stagflation in the world economy is rising, although I completely disagree with that. And the foundation for domestic economic recovery is not yet solid, according to China's National Bureau of Statistics. Stagflation refers to long-running high inflation combined with rising unemployment and weak growth. And here you can see that those days are gone. You see the 4-week moving average of initial claims in red, the consumer price index in blue on a year-over-year rate of change. And notably, when you see, even in the 70s, you see initial claims rising, yes, you can still see inflation going up, and then it comes crashing down. Claims rising and inflation coming down. Claims rising, you see inflation coming down again, and now it is going to happen another time. And that's why those 4-week moving average of initial claims is such an important data point to watch. Of course, we'll talk about that more on Thursday when we get the next release. But this shows about China and the property development market is about to come crashing down as China's crisis wipes out $90 billion of a developer market value. And of course, remember, these developers need money. They need to go to banks. They need to show that they have value to get money to finish properties, to get people who are not paying on their properties to start paying again. And when you have this issue, of course, they're losing value. That means banks are unlikely to want to lend to them, as builder shares weakest since 2012 and junk bonds at record lows as the sector outlook dim as Beijing prioritizes appeasing homeowners. As Chinese builders' fortunes have decidedly worsened this year following a relentless official campaign to curb their debt expansion and a year-long slump in home sales. This has led to an unprecedented cash crunch that is spreading risk to the financial system and threatens social stability. It's not just a Chinese issue. This is going to head around the world, as our chief strategist follows up in his daily report, which you can get at marketsinsiderpro.com, link in the description below, as he talks about the Empire Fed Regional Manufacturing Survey, as he notes that but with such a historic drop in the latest update, we're reasonably certain there must have been a substantial downturn in activity within the central bank's central second district. Now keep in mind, that was a 1-week data point that it was looking at. It's not not very long. So it's telling you something severe has changed. These regional surveys show that the manufacturing economy has been slowing down, if not already contracting, by the first few months of the year as inventory had been piling up since late last year, meaning this isn't about rate hikes. That imbalance has suffered the March oil shock, which had turned into annoying levels, notably that March again, annoying levels of unsold goods at retailers and wholesalers into concerning levels by May and June. If consumer and business demand has fallen again, then inventory levels have now become alarming and therefore the plummet in at least the Empire State numbers, and that translates into China because when demand in the U.S. falls for goods, well, of course, the world's largest importer is going to see their demand fall as well, suggesting they're heading into a recession first, and we're not far behind. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.